Hello and welcome to MediaNama. The Ministry of Finance has introduced a draft bill aimed at banning unregulated lending activities, including the advertisement and promotion. The bill defines unregulated lending as any lending activity not covered by existing banking and finance laws, with the specific inclusion of digital lending practices. The bill establishes a framework for enforcement through the appointment of secretary level officers as the competent authority. These authorities will have civil court powers during investigations, including the ability to summon individuals, examine them under oath, and compel document production. They can also provisionally attach accounts of suspected entities. A designated court will be established to handle cases under this Act. A central database of lenders operating in India will be created and maintained, accessible to the public for verification of regulated lenders and the reporting of illegal practices. Both lenders and banking companies will have obligations to report information about their operations and suspected unregulated lending activities. The penalties outlined in the bill, including imprisonment from 2 to 7 years and fines between rupees 2 lakh and rupees 1 crore for unregulated lending. For wrongful inducement, offenders face 1 to 5 years imprisonment and fines up to rupees 2 lakh. Repeat offenders may receive 5 to 10 years of imprisonment and fines between rupees 10 lakh and rupees 150 crore. All of these offences are designated as cognizable and non-bailable. The bill grants police officers authority to conduct warrantless searches and seizures when necessary, prevent evidence concealment. They may also freeze bank accounts and properties connected to unregulated lending activities. Both central and state governments will be authorized to create rules for implementing the Act subject to legislative approval. The bill appears to be a reaction to a number of reports about predatory lending apps which offer loans at high interest rates and then use criminal intimidation when borrowers fail to pay the money back. Just last month, the Enforcement Directorate arrested two Chinese nationals under provisions of the Prevention of Money Laundering Act. They were accused of being part of a scheme which dispersed short term loans through various apps alongside an exorbitant rate of interest. The individuals had established two companies where they forced Indian employees to act as dummy directors while maintaining full control of operations. They then created mobile apps targeting financially desperate Indians, offering quick loans between 5,000 and 10,000 rupees. When borrowers failed to pay back the loan, the lenders launched aggressive harassment campaigns that involved verbally abusing and threatening borrowers alongside their friends and family. They also created fake obscene images of borrowers and threatened to share them online. In February last year, the IT ministry started the process to block 138 betting apps and 94 loan lending apps with reported Chinese links. The same month, the RBI cancelled the licenses issued to two non-banking financial companies, Kudos Finance and Investments Private Limited and Creditgate Private Limited. The bank stated that the certificate of registration for these companies has been cancelled on account of violation of RBI guidelines on outsourcing and fair practices code in their digital lending operations undertaken through third party apps, which was considered detrimental to public interest. These companies were also not complying with the extant regulations pertaining to the charging of excessive interest and had resorted to undue harassment of customers for loan recovery purposes, the RBI stated. The RBI also announced more recently in October this year that it had barred four NBFCs Navi Finserv Limited, DMI Finance Private Limited, Ashirvad Microfinance Limited, and Arohan Financial Service Limited from sanctioning and disbursing loans. The central bank found that there were material supervisory concerns in the pricing policy of these companies in terms of their weighted average lending rate, or WALR. Further, the interest spread charged across over their cost of funds was excessive and did not adhere to the regulations in the microfinance loans direction and NBFC scale based regulation directions. The RBI stated that the entities also did not conform to the provisions under the Reserve Bank's Fair Practices Code. The central bank also found out that the NBFCs failed to adhere to the regulatory guidelines on assessment of household income and consideration of existing proposed monthly repayment obligations in respect of their microfinance loans, in addition to usurious pricing or excessive interest rates. It also observed deviations with respect to income recognition and asset classification norms, evergreening of loans, conduct of gold loan portfolio, mandated disclosure requirements on interest rates and fees, outsourcing of core financial services, and some other discrepancies. The RBI also stated that it had warned regulated entities on the need to use their regulated freedom responsibly and ensure fair, reasonable, and transparent pricing, especially for small value loans. The public database of lending apps mentioned in the bill is also very similar to an initiative announced by the RBI Governor Shaktikanta Das earlier this year, who had previously stated that they plan to create a public repository for digital lending apps after a number of apps claim to be RBI regulated entities. The central bank also reportedly considered setting up a Digital India Trust Agency to create a whitelist of legitimate lending apps that could be shared with law enforcement. The Parliamentary Standing Committee on Communications and Information Technology had also recommended that the Indian Cybercrime Coordination Center, or I4C, maintain a repository of fraudulent loan apps and also periodically send hash values of these apps to app stores for appropriate action in its reports on digital payments in February this year. In April, the RBI had also announced a set of new draft guidelines for web aggregators of loan products, facing greater transparency requirements. All of these developments together indicate a growing scrutiny on predatory lending from regulatory agencies and the government. Thank you for watching. For more tech policy updates, please subscribe to MediaNama.